everyone, Mike Giordano here. Hope you've had a great summer. You made all kinds of wonderful memories, awesome vacations that you'll never forget. My wife and I, we had our third child this summer, so a vacation for me right now is just sleeping in past 5 a.m. Yes, 5 a.m. If I don't have to get that first cup of coffee till after 5, I've probably had enough sleep, and I'm good to go for the rest of the day. So while we got some brain cells functioning here, let's talk about what's happening in the economy, the markets. I'm going to give you a real high-level overview. You want specifics, reach out, give me a call. Okay, we're going to talk about how the markets have played out, what the economy looks like. First thing I want to show you is exactly what's been going on in the market so far this year, and it's kind of been a reversal of last year. Last year, the Dow was the best performing indice relative to the S&P 500 and the Nasdaq. This year, completely flipped. Nasdaq on top, Dow on the bottom. Nasdaq of this purple line, it's really rocketed higher. Had its best first half of the year, in fact, ever. And that's because this tech-heavy indice, first off, had a horrible 2022, and then, we didn't really get the recession that everyone was expecting at the beginning of the year, and so that kind of gave an opportunity for these stocks to recover. And then you get this AI craze, artificial intelligence, and it just kind of took on a life of its own, and that kind of helped excite investors and help power the Nasdaq higher. However, if you think that you're getting these higher stock prices, you would think, I should say, if you get higher stock prices, you would think that, bond yields should be falling because, bond yields are financial gravity. They're kind of what, higher bonds go, higher bond yields go, the more it puts pressure on other asset classes, including stocks. But look at this. I mean, bond yields have done anything but fall. They've been going higher. In fact, they're up to 4.27%, which is basically in line with our highs for the cycle back in October. And we've moved a full percentage point up from where we were in April. So if you peel back, and look at, historically, you got to go all the way back to 2007 before you see interest rates at a level similar to where we are today. And so it's quite a remarkable change, and yet we haven't had material breakdowns yet in the stock market. One of the reasons for that could be simply this. Take a look at trading economics, and here's a chart of the CPI core inflation rate. And so core is important to look at here because while food and energy are big components of the overall indice, they can create so much noise because they're so volatile. I mean, weather conditions, wars, all these kinds of things play into food and energy prices, and they don't give you a great gauge of where underlying inflation is and where it's likely to go in the future. So that's why policymakers certainly like to look at where the core inflation is when they're trying to make determine policy. And so core CPI was 6.6% back in September of last year, and it has steadily moved down. We did have a period there of 5 or 6 months where nothing was happening, but we had a big jump down here in June, and then it continued into July. We'll get the August numbers coming up next week. But we're seeing really, really good progress on inflation. But still, at 4.7%, we're still a ways away from the Fed's goal of 2% inflation. Okay, so what does this all mean for corporate profits? You take a look at what expectations are for how much S&P 500 companies are going to earn in the future. And that's what this chart from FactSet is showing you. Is basically this bottom line is 2023 projected earnings, and the top line is 2024 projected earnings. And we kept seeing those numbers going down, 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 down into the summer. And then we got a little bit of an inflection point here in the middle of July, where they kind of bottomed out, and now forecasters are getting more bullish going forward. Doesn't mean it's going to hold because, you get head fakes all along the way, and anything could pop up. They could derail the markets and derail expectations for future profits. But the markets are forward-looking, and so they like to look out 3, 6, 9 months into the future. And so expectations of what's going to happen in the future are so important, and they weigh heavily in many investors' minds. And that's not to say that the past data is completely irrelevant, doesn't matter. It's just that expectations are so important in terms of trying to figure out what to pay for stocks and at this time and then into the future. So, analysts getting more bullish. That is a positive for stock investors. Okay, so let's recap here. We've got inflation's been coming down. That's been positive for the stock market, bond market. You're seeing yields higher. And you're now starting to see corporate profits start to move somewhat higher in terms of expectations for not only this year, but next year. basically what's happening is that we've got the soft landing, narrative continuing to play out. We have had inflation coming down with not a great spike in unemployment. That's kind of what the Fed's been hoping for. The game's not over yet. Not until we get closer to 2% inflation can you say, yes, if we don't have a high spike in unemployment, the soft landing was able to hold. But the fears that people had coming into the year have not materialized yet. And I say yet so many times because that's really, it's an ongoing game. So you can't really look at where we are today and say, okay, look at the scorecard and figure out who's the winner and who's the loser. So lots of positives out there. The good thing about interest rates being higher now is that now you have new opportunities in the markets that you really haven't had maybe over the last decade or so. So you have different places to put money in your portfolio to try to get not only yield and current income, but also total return over time. And so if you're looking at trying to figure out, okay, what pieces do I need to put in what places to get me to achieving my own goals, reach out. We can discuss these things. As I mentioned, 2:30, 3 o'clock in the morning, perfect times to reach me. I'm usually up. I've got the baby cradled, football style, and I've got screaming in one ear, so maybe if I've got your voice in the other ear, it can kind of balance things out. Well, unless you're screaming at me too. Have a good one, everyone.